You spent your entire career paying into Social Security. Taxes came out of every single paycheck to fund it. So here's a question almost nobody asks until it's too late. When that money finally comes back to you in retirement, can the government tax it again? For millions of Americans, the answer is yes. Up to 85% of your Social Security check can be counted as taxable income. Most people have no idea until the first tax bill lands. By the end of this video, you'll know exactly when Social Security gets taxed, why more retirees get caught every single year, and three things that can lower what you owe. This video is for informational purposes only and does not constitute financial or legal advice. Always consult a qualified professional before making financial decisions. Here's something most people don't realize. For the first 50 years of Social Security, benefits were never taxed at all, not $1. That changed in 1983. The program was running short of money, and the commission, led by economist Alan Greenspan, appointed by President Reagan, proposed a fix. Starting in 1984, up to half of your benefits could be counted as taxable income, but only if your total income rose above a certain line. At first, it touched almost no one. Then, in 1993, under President Clinton, Congress went further. For higher income retirees, up to 85% of benefits could be taxed. A handful of numbers were written into law back then. And to understand your tax bill today, you have to understand what those numbers were and what nobody ever bothered to do to them since. Social Security doesn't look at your benefit alone. It uses a figure called provisional income, sometimes called combined income. The formula is simple. Take your adjusted gross income, add any tax exempt interest, then add half of your Social Security benefits. That total is what decides your tax. Here are the lines that matter. If you're single and your provisional income is under $25,000, none of your benefits are taxed. Between 25 and 34,000, up to half becomes taxable. Above 34,000, up to 85% is taxable. For a married couple filing jointly, the lines are 32,000 and 44,000. And one hard rule works in your favor. No matter how high your income climbs, you are never taxed on more than 85% of your benefits. Now, back to those numbers written into law: 25,000, 32,000, 34,000, 44,000. Here's the part that changes everything. Those thresholds have never been adjusted for inflation. Not once. The $25,000 line from 1984 is still 25,000 today. The 85% line from 1993 hasn't moved either. But wages, benefits, and the cost of living have all climbed for 40 years. So every year, more retirees cross lines that were drawn for a much smaller economy. You can see it in the data. In 1994, the taxable share of all Social Security benefits was just over 12%. By 2022, it had grown to 38%. Today, about half of all beneficiaries pay no tax on their benefits, which means the other half do. And that tax money doesn't vanish. By law, it flows straight back into the Social Security and Medicare trust funds that pay the benefits in the first place. The share keeps rising, not because of any new law, but because the old numbers were simply left frozen in place. It's tempting to assume this only hits wealthy retirees. It doesn't. Remember how provisional income works. It counts your other income plus half your benefits. So, an ordinary pension, a part time job, or a routine withdrawal from a 401k can quietly push you over the line. Take a hypothetical single retiree, call her Susan. She receives $30,000 a year from Social Security and pulls $35,000 from her IRA. Her provisional income isn't 65,000, it's her 35,000 plus half her benefits, 15,000 for 50,000 total. That's well past the top threshold. So up to 85% of Susan's benefits are now taxable. She isn't rich, she's middle class, and she's exactly who these frozen numbers were never designed for, but now catch anyway. There's also a lot of confusion right now about a recent law, and it's worth clearing up. In 2025, a bill, often called the One Big Beautiful Bill, created a temporary deduction of up to $6,000 for people 65 and older. Some headlines, and even an official email, called it the end of taxes on Social Security. That is not what it does. The law didn't repeal a single rule we just walked through. The thresholds are unchanged. Provisional income still works exactly the same way. What the deduction does is lower taxable income for some seniors, which can shrink the bill, and for some, erase it entirely. But it phases out at higher incomes. It's scheduled to expire after 2028, and plenty of people still owe tax on their benefits. So, if you heard Social Security is now tax free, it isn't. It's a temporary discount for some, not a repeal for all. There's a deeper trap hiding inside all of this, and financial planners have a name for it: the tax torpedo. It works like this: when you pull an extra dollar from a traditional IRA or 401k, that dollar doesn't just get taxed on its own. It also raises your provisional income, which can drag more of your Social Security into the taxable column at the very same time. Here's a simple example. Say you're in the 22% tax bracket and you take an extra $1,000 from a traditional IRA. You'd expect to owe $220, but that withdrawal can also make up to $850 of your Social Security newly taxable, adding almost $200 more. Suddenly, that $1,000 withdrawal cost you around $400 in tax. That's an effective rate north of 40% on income you thought was taxed at 22. Your bracket said one thing, the interaction said another. That's the torpedo. So, what can you actually do about it? Three levers matter more than the rest, and none of them require being wealthy. First, control the timing of your withdrawals, because provisional income is the trigger. When you take money can matter as much as how much. Many retirees benefit from drawing down traditional accounts in lower income years. Often, the gap between retiring and claiming Social Security, so that later withdrawals and later taxes on benefits are smaller. Roth accounts help here too. Money you pull from a Roth generally doesn't count towards provisional income at all. Second, if you give to charity and you're old enough to take required minimum distributions, look at a qualified charitable distribution. Sending money straight from your IRA to a charity satisfies your required withdrawal without adding to your income. which can keep more of your social security out of the taxable range. Third, know your state. In 2026, 8 states still tax Social Security benefits in some form: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Though several offer income based exemptions, so many residents there still pay nothing. West Virginia just finished phasing its tax out completely, bringing the total to 42 states that don't tax your benefits at all. Here's the honest bottom line: you can't always avoid tax on your social security, but you can often control how much and when. The single most useful habit is to stop looking at each account in isolation and start watching one number: your provisional income for the year. A withdrawal that looks harmless on its own can quietly tax your benefits. A little planning, the order you tap your accounts, the years you convert to Roth, the way you give, can be worth thousands over a full retirement. And if someone you love is living on these checks, send them this. Nobody should meet this tax by surprise. This isn't about beating the system. It's about not paying more than the law actually asks of you, simply because no one explained how the math works. For 50 years, Social Security was never taxed. Then a few numbers were written into law: 25,000, 34,000, and left untouched while the world around them changed. That is the quiet reason more of your benefit is taxed today than at any point in history. Knowing where those lines sit and how your own income moves around them is the difference between guessing and planning. That's what this channel is here for. Not to tell you what to do, but to make sure the rules are never the thing that surprises you. Subscribe, and let's keep making these decisions clearly, one episode at a time.